cloud. And I will just turn this on and share my screen. Share screen number 2. Can you see that screen okay? Is that fine? Everyone can see my slides?
Yeah, I got it, mate.
Yeah, excellent. Thanks, mate. So 2021-22 federal budget, what does this mean for you? So that was the slogan that we came up with when we were preparing this webinar. As I said, purely based on an income tax and superannuation side. We're accountants, financial planners, we love this stuff. But as I mentioned previously, there's some big infrastructure spend. And one thing I was reading today and also got word of is that I think it was 420 million in upgrading the Bruce Highway. So it was a bit closer to home. Some infrastructure spending on the Gold Coast Light Rail for those people that travel down that way. Bit of spending on the Cairns Arterial Road. So there's a fair bit of infrastructure spend on Queensland roads and also, I guess, transport. Big one was aged care. I think there's 80,000 new aged care in-home places. So they're trying to make the aged care similar to the NDIS scheme, which I think will be really good. I've got a fair bit of involvement with NDIS on a volunteer basis with some organisations. And also a bit of extra money for NDIS as well as for women's health. So, which I thought was very good, good policy from that point of view as well. Not that I'm political, I just thought they were great initiatives anyway. Obviously, there's been a lot of talk about how much debt and how much deficit the budget's in as well. I'm not going to go into that too much today. That's what an economist does. But obviously, there's going to be more expenditure than spending in the budget for this year. And part of that's going to be the tax, I guess, offset increase, or sorry, not the increase of the offset, but the increase in time of the offset. It's been brought in for another year. And also the instant asset allowance write-off is going to extend for another year as well. So without further ado, so my part's going to be about personal income tax changes and business income tax changes, and Brent's going to talk to you guys about super as well from there. But the big one, which was all over the news, was the Lamington. I don't know if we've all heard the term Lamington, but this was the first time I'd heard it being called a Lamington was on Tuesday morning. But it is the low and middle income tax offset, colloquially known as the Lamington. It's going to be retained for the 2022 financial year. So exactly what's happened in the 2021 income tax year, whereby individuals between 48,000 and 126,000 will receive a maximum of $1,080 tax offset on their income tax return. So unlike previous offsets which have occurred, which sort of come out during your wages cycle, this one happens at the end of the tax year on your tax return. There's also up to $255 for people earning up to $37,000 or less. There's a shade-in period between $37,000 and $48,000 per year taxable income, where it sort of increases by 7.5% for every dollar over 37,000. And then there's a phase-out period from 90,000 to 126,000. So, for example, if you earn $100,000, your Lamington tax offset or your low middle income tax offset would be $1,080 less $300, which is 3% of $10,000, which would be $780. So it sort of phases in up to the 1,080, up to 48,000, and then it shades back out and it phases back out. Once you get over to 126,000, it's gone altogether. So it's applied to reduce the tax payable by individuals when you lodge your income tax return in the 2022 financial year. So that starts from the 1st of July through to the 30th of June next year. It's already in place this year when you do your income tax return, coming up in the next few months of the change over the financial year. So we'll have that for 2 years now, which from memory, I think Brent was about $9 billion expenditure. Is that correct? I didn't put the figure on here, but I think it was $9 or $7 billion a year.
It was huge.
It was huge, yeah. Big numbers, isn't it? That's going to happen for it. Obviously, the objective of this tax offset is that when everyone gets their tax return, they're going to go to Jerry Harvey and buy a TV or something similar. I think that sometimes they call it the Jerry Harvey offset last year, but they want to get people spending in the economy. The second thing that's hasn't really been spoken too much about, which is still pretty important, is the increase in the Medicare levy low income thresholds for the 2021 income year. So that's for this year now. So the Leamington was in for the 2021 and the 2022 financial year, but the Medicare low income threshold was a new measure that's going to happen from this tax return now. So they're just going to increase it a little bit where you have to pay the Medicare levy, which is the 1.5%. That's going to go from 22,800 to 23,200. And for families, it's 38.4 to 39.1. So a little bit of an increase there. And for single pensioners and family pensioners, it goes up by a little bit based on your use of the Senior Australians tax offset, or the SATO. So for each dependent child or student, the income threshold is increased by a further 3,597. So when people ask you, oh, what's this Medicare levy? Some people in the lower end of the scale don't have to pay it, but anybody above that sort of 39,167 for families, once you add children in, pay the 1.5% Medicare levy. There's also the 1% Medicare levy surcharge, which is unrelated to this and has a different income threshold as well from there. The other thing really targeted at individuals, there's two other main measures in the budget. But the first one was the $250 threshold for self-education expenses has been removed. So previously, if you had self-education in relation to your employment, the first $250 of that was non-tax deductible. That's now changed, and all self-education expenses from the first dollar are effectively tax deductible. So it's just going to reduce a bit of compliance costs, bit of messy tape as far as having to calculate $1,000 minus $250, etc., just to make it all deductible from there. I think what was happening was that people were then putting it in other spots in tax returns, as in other work-related. So it wasn't really having the full effect anyway. It was being incorrectly done. So what they've decided is, well, let's just make it all deductible, make the compliance a lot less, and go from there, which is what they're saying by reducing compliance costs. So that's effective from the first income year after the date of royal assent. So that's provided the budget goes in, gets approved by Parliament by the 30th of June. It will start for the 2022 financial year, which is what they're hoping to achieve from that. The next one's quite a big change, a good change, but it doesn't apply to too many people. But one of our partners, Darren Smith, sent around something yesterday saying that we're still well behind employee share schemes compared to other countries in the world. And I must have to say that is the case. But what the government have done with employee share schemes, and there was a bit about it, it's mainly aimed at startup companies where people don't actually get paid for all the work they do. Instead, they get issued shares as a result of it. Or the big end of town, whereby I guess managers and general managers get paid bonuses and shares rather than cash. What they're effectively saying is that the first taxing point used to be when you left your employment, you'd have to pay tax on all the shares that you've received at that point in time. So that was quite cumbersome. If you left the job, you got given $50,000 worth of shares, bang, you got $50,000 taxable income, you have to sell your shares. And that's not great for some of those smaller companies, because then other people have got to find the money to go and buy the shares. And that's not always easy. So what the government's effectively done is they've said, we'll remove that point whereby when you leave the company, you're no longer taxed then. You're taxed at a few other points along the way. So either when you sell it, or when the risk of forfeiture or restrictions on disposal being released, or the 15-year deferral fee, of deferral period of time, not deferral fee. So it's really making it attractive for people that have left companies to keep the shares that they had in that startup phase of the company, or if they want to keep it for the longer term, they can choose to do so. So we've had clients that have left companies and been essentially taxed on a large amount of employee share schemes at that point in time, which hasn't been great, which has meant they've had to sell some of their shares. So that's now all avoided because they can really hold on to those shares until a future period of time. That was about it for individual tax changes in the budget. So as far as an individual, it was really 4 key measures. There was a measure there about the tax residency rules. They're sort of streamlining how that's working. keep it to a simple 183-day rule, which is quite interesting. But we don't really see, probably once or twice a year we have to really consult on that sort of stuff. The next part that I'm going to talk about is a couple of things that are going to apply to businesses for the 2021 and the 2022 financial year. The big one is the full expensing of depreciable assets. So any business that has a turnover under $5 billion can fully expense eligible depreciating assets until the 30th of June 2023 now. Previously, that was 2022, but they've extended that out a year, and provided that it is acquired after the 6th of October 2020, when it was first announced in that COVID budget we had, it needs to be installed ready for use by the 30th of June 2023. That's really good for businesses. A lot of businesses have taken advantage of that. And it just provides some certainty where people aren't going to go all out rushing before the 30th of June 2022. They can really plan this out over a number of years. So it just doesn't create the big peaks and valleys in capital investment. We're able to really sort of plan it out over a couple of years in that, hey, we can still get this expense when we need to at that point in time. On a similar measure, the temporary loss carryback extension also occurred. So they dragged this one out for another year also. This one is going to really start coming home in this financial year and the next financial year. But essentially what it means is that if you made a profit in 2019, 2020 or 2021, and you paid income tax in the company structure, you can claim that loss back. So you can claim that tax back if you make a loss in the following financial years. Perfect example, if you make $100,000 taxable income in the 2020 year, 2021 year, you make $100,000 taxable loss. Well, whatever tax you paid in 2020, you can get a refund of that back in 2021. So it is a really great planning tool, whereby sometimes people make profit in one year and loss in another year, which isn't that great. We're able to sort of plan it out over the peaks and valleys of the business cycle as well. So that can come in handy, especially with these uncertain times in COVID. But also if you're looking to buy a really big piece of equipment, that can create a tax loss, which means that you will get the tax back from the previous financial year. So a great example of that is, for example, if you bought a big dump truck and you're in the earth moving business. Usually you'd make sort of 300 grand a year, but your dump truck cost you $500,000 a year. Well, then you're able to claim back the $300,000 a year that you would have paid tax on in the previous year because you had a loss in the following year. So it really does encourage investment, and it also allows people to plan ahead from a tax point of view, knowing that they can get a bit of money back from previous taxes they've paid before times changed. The other measure doesn't really too much apply to, I guess, around our area, although there was a little bit of it, whereby they're saying that any Category D grant from the federal government is going to be tax-free. So it's not assessable, not exempt income for tax purposes. So they've extended that out. They did that for a couple of the grants previously. So anything due to the rainfall events between the 19th of February 2021 and the 31st of March 2021 will be non-assessable, not exempt, tax-free income. So good measure by the government. They sort of do this every time one comes out. They sort of announce a bit later that it's tax-free. You might remember when we had the floods down in Rockhampton and farmers' fences got rained out, that those fencing grants were later on made tax-free or not assessable, not exempt income. That's the same again for this flood event that's happened down south as well. So, ooh, my voice is going. So I'm just going to hand you over to Brent, mate, and I'll let you go through the superannuation changes that have happened in the budget. And then I think we might have a bit of a 5-minute Q&A and also a bit of a chat about what our thoughts are going forward on business in the region and how this budget's going to affect it.
Sounds good, mate. Thank you. If you can just skip along the slides, please.
I'll do that for you.
Legend, thank you.
Cool.
So the first big one, and I think it's a big one because I think it got glossed over a little bit, but as a financial planner, I think there's a lot of scope to use this rule. So for those that aren't aware, if a couple of years ago, up to age 65, anyone could put money into super. Didn't matter if you're working or not working. Then they extended that rule through to age 67 with there being no work test. But so the work test is basically you have to work 40 hours in a 30-day period. And you have to do that before you can put money into superannuation. And that currently applies if you are over 67. Expected to start from July 22. So obviously all these rules need to go through Parliament and become law first. But yeah, they're proposing that the work test gets abolished. And that would be for only two types of contributions. So that is a non-concessional contribution, which is an after-tax contribution, or also salary sacrifice contributions. So a lot of people make the concessional contributions, and that's your tax deductible ones. That won't be included in this. So you will still have to meet a work test to contribute under that concessional contribution. But this really gives a lot more people flexibility to add extra money into super later on in life. And the other thing from a financial planning perspective is there's things called withdrawal and recontribution strategies. We sometimes use them a bit as advisors to help reduce any potential tax payable on the death of a member of a super fund, because I think a lot of people don't probably realise that there could be, for want of a better word, death tax on superannuation on the passing of a member. So this really opens that up a lot. While we're talking about contributions, this wasn't in the budget as such, but there's been an indexation applied. So the current contribution rules are $25,000 for a concessional contribution, and the non-concessional contribution limit is 4 times that at $100,000. From 1 July, so from next financial year, those limits are actually going up a little bit. So a concessional contribution amount is going up to $27,500. So there's an additional $2,500 that you can put in under that under that concessional cap, which gives you a bit more of a tax deduction. And the non-concessional one actually goes up to $110,000. So those amounts are increasing. So yeah, I think it's a bit of a sleeper, this one. They probably didn't make a big deal of it, but from a financial planner's perspective, there's definitely a lot of scope to do work with this. Now there has been some also uncertainty around whether or not by removing this work test for these non-concessional contributions, whether that's going to impact the bring forward rules. So for those that don't know, the bring forward rules allow a person currently who is 64 in the financial year to actually do 3 years worth of non-concessional in one go. There is currently legislation in the Senate at the moment that is extending this to 66, but there's been no clarity from the government or Treasury if they're intending to allow that to go up to 74 with this work test change. So bit of a watch this space, but that'll come in from 1 July 22, all going to plan. So yeah, there's definitely some more options available there. Next slide, please, mate. The downsizer. So I've only actually personally used the downsizer contribution limit once for a client, and they're basically just reducing that age limit down from 65 to 60. So this gives people a one-off opportunity to make up to $300,000 contribution to super, basically without having to meet any sort of work test or anything like that. And it's on the proviso that people are selling their house that they've held for at least 10 years, and it doesn't count towards your cap. So in theory, going forward, if you can use $300,000 each for a couple, that's $600,000. Plus, if you had your non-concessional limits of $110,000 a year, also if you use the bring forward rule, you can probably get in up to what's that? A bit over 1.2 million into super. So it really gives some flexibility and options for people to get some big sums of money into super and into that lower taxed environment. Again, this is likely to start from 1 July 22. you just got to read the rules carefully around whether or not your residence will count. If you're looking at this strategy, whether or not it will count towards the downsizer contribution amount. Next slide, please, mate. Removing the $450 per month threshold. So Pete, feel free to chime in here. Basically, employers aren't obligated to pay SG if there's if wages are less than $450 a month. So I haven't actually had a chance to have a chat to you yet, mate, around this, but obviously, I don't know, anyone going forward, potentially, like, people will have to put SG through their payroll and that sort of thing for everyone, really.
Yeah, I was actually, I kind of put my foot in it yesterday afternoon with a good client of mine. I said, I haven't really got too many people that pay under $450 per month, apart from the school kids, which that exemption still sort of applies, which is the under
Yes.
the 16-year-old one. But she said, no, she's got 3 jobs and she does 5 hours a week, sort of for each, I guess, charity. If you know what I mean, she gets paid $300 a month
Yep.
from each one, and she doesn't get paid super, and they have to pay her super. So there's a lot of people that sort of have those sort of little school canteen jobs, if you know what I mean. It is going to catch out those sort of.
Well, that's right. That's what it's basically designed to doing. And one of the comments made was with part-time workers, the majority of these workers are actually females.
Yep.
So yeah, it's designed to sort of help capture their superannuation that they should be getting. And one of the figures I saw, mate, was someone, what was it, a 30-year-old with a super balance of $50,000. It's going to make a difference of at least probably $12,000 to $15,000 in retirement. So it's not huge, but it is obviously money there that goes towards people's
I think it makes it a bit easier, and it stops that little loophole where someone might not, especially if you're an 18 or a 19-year-old and you're a uni student, they might try and get you under the 450, if you know what I mean.
Yep.
So it does stop these little things sort of creeping in. From that point of view, it makes it a fairly even playing field. I guess it's like the self-education thing. They just remove the thresholds. It just makes it easier.
Yeah, just pay everyone.
Yeah, exactly right. So I think it's quite good. It will put a bit more of a burden on some employers who don't currently pay super because they only do those sort of small amounts, like those little charities and that.
Or some places that have a lot of younger, like uni students working for them sort of casually in that. So
yeah, the casual ones that will catch them out. But I mean, they've given people plenty of time through SuperStream and things like that. Now, if that had happened 5 years ago, it would have been very difficult because you're sort of manually doing it. But with programs like Xero and MyOb and QuickBooks, like, you should be able to just automatically pay the super anyway.
Yep.
Do you know what I mean? So it's, yeah, for those sorts of businesses, they should already be on the SuperStreams and the single touch payrolls. So the level of compliance is sort of decreased to make this a bit easier. So yeah, there will be a little bit in it, but I think it's probably good policy. Yeah.
Very good. If we just move to the last one, please. I haven't seen too much of this myself, but the First Home Super Saver Scheme. So basically, that's just where the government's allowing younger people to sort of put some more money into their super, to pull it out at a later date to help buy a house. So they're basically just increasing this amount up from 30,000 to 50,000. It hasn't become clear yet either whether or not they intend on increasing the annual amount you can make. So that's currently 15,000. So I just have to wait and see there, but it obviously allows people to save up a bit more via their super to help themselves get a house down the track. So
once again, mate, I think this is really, you're probably right. You haven't seen much of it, but it's this younger generation coming through that will start to do this. And I think this is probably all a bit of a part of that to sort of increase it from that point of view. Like, I do know a couple of people that are doing it from that point of view. Like, they do the extra super. I was talking to a guy yesterday about, he was telling his kids they really need to sort of salary sacrifice an extra X amount in a super and then get it out when you get your house, because it's going to save you a bit of tax from doing it. Plus, it gets your super earnings up and things like that.
Yep, that's right.
As you know, if you have a managed investment outside of super and you're on sort of 40 or 50 grand a year, you're taxed at 32% on it, aren't you?
You lose a third to tax, that's right.
Yeah, so if you're a young'un, I guess, and you could put more money away rather than putting it in a managed investment outside of super, and you are saving for a house, why wouldn't you put it into super? Get the tax deduction, tax to 15%, you are increasing your benefits by doing that. So
Yep, definitely.
yeah, I think you'll find a lot of the younger generation will start to do this one. That's for sure.
It's one of those things, like it takes a while to get a bit of traction, but I think once people realize the benefit of it, it will kick off a bit more.
Yeah, like I guess maybe some of friends of mine who've got that sort of older teenage sort of kids are really starting to talk about this sort of thing, encouraging them to put money into super, especially when bank deposits are what 0.5 or 1% or something, and your super's earning 6 or 7% steadily. There's a lot of encouragement for that, so I think that will continue.
And that was it from a superannuation perspective. Nice and fairly uneventful, but as I said, I know there'll be a lot of work across our client base with that potential removal of that work test. I can see us being very busy with that. So
I think from our point of view, mate, it's going to be the fact that clients that have sort of low, if you've got a basic tax return and you have sort of $100 interest or $200 interest, you're going to get a refund. I think that's encouraging for everybody because you are going to get that $1,080 if you're between those two thresholds. So I think that works out quite well, and sort of means people aren't really going to push the deductions limit because they are getting that refund anyway, as a whole. So that's quite good. And the other thing from my point of view was essentially is that they've extended out both the loss carryback and the instant asset write-off, which is brilliant for our businesses, that's for sure. So they were our two big ones from an accountant's point of view. Anyone got any questions or comments in the chat? I'll just move it back to
nothing in the chat, Pete.
Nothing in the chat box. No. So we thought we'd just provide everyone with a really brief. It's pretty comprehensive. There's not much, as I said, that was pretty much everything in the budget from a tax and superannuation point of view. But we'd provide everybody with an overview of the changes that are going to happen in the 2021 and the 2022 financial years, and also just try and keep everyone up to date with what's happening in that sort of field.
And just probably to reiterate, you can't go and do any of this stuff yet. It's not law yet. Has anything passed yet? I know sometimes they whip some stuff through, but I haven't seen anything getting passed yet.
No, nothing's passed. Letitia's asked a great question. Any movement on the company tax rate mentioned? Yes, there was mention that they're still committed to stage 3 of those tax cuts on the 1st of July 2024, and they've been locked in. So from my understanding is that tax rate will then reduce to 25% at that point in time, and they're still committed to that as well. The individual tax rates will still have that tax cut in 2024 as well. So that's where they're going to have that massive big tax bracket between $40,000 and $200,000. So they're still committed to that at this stage, which is brilliant from everyone's point of view, really, that you're not going to have to worry about bracket creeps or getting people into certain brackets. So those tax cuts are still in play at that point in time. Just making sure I got the figure right there, that's all. But I'm pretty sure that that's the case. Any other questions at all?
Oh, if there's no more questions, mate, we might wrap it up there. We've hit 5 o'clock, so keep it short and sharp.
All right, I will just clarify my statement then. So in the 2024-25 financial year, the tax rate's going to be 30% between the income rates of 45,000 and 200,000. Anything over 200,000 will be 45% plus your Medicare levies from there. So they're still committed to that. And then from 18,200 to 45,000 will be 19%. So there's really only 3 tax brackets, whereas sometimes we've had 5 tax brackets. So I think that's definitely still being announced that will occur from 1 July 2024. And the company tax rate at that point in time is going to change down as well to that 25%. Cool. Great question though, Letitia, because they did recommit to that on Tuesday night. can see a lot of restructures at that date. Yeah, leading into that date, there will be a lot of restructures at 25%. That's for sure. Because I'm not really going to get into it. Everything I read says that the ATO loves companies, and Darren will get ready, Pete. That's for sure. But Darren will tell you this, especially. But everything you sort of read since COVID with the company loss carry forward, the instant asset stuff, the ATO is really liking companies rather than trust structures. And I think that's essentially why they're really starting to have this company tax rate 25%, and that they like the idea of it just all going through a 25% company rate. So you're right, it's that when you do have it in a company, you've still got to get it out to the individual. So the individual just pays as much tax as they get it out of there. But yeah, you are right. There's a lot of work coming up with restructures, that's for sure. And we've started that with a lot of clients now, sort of for a few other reasons, but also trying to get ready for this sort of stuff that is going to happen, provided that we have the same government. Yeah. Everybody else is pretty good. I'll let you wrap it up, mate, so I can save my horse.
Yeah, save your voice. I know you're struggling a bit. Yeah, again, thanks everyone for coming. Really appreciate your support. We'll send out a copy of the slides. We did send out a budget update the other day. Yeah, Pete's got it on the screen there. If you've got any more questions, yeah, feel free to reach out to your accountant or your advisor here at Canars. We do have another webinar coming up, so it's going to be a market update. We're doing that again with Vanguard, so that's going to be Thursday fortnight, the 27th, same time. And then I suppose, Pete, we're going to have to get cracking soon too, also on a bit of an end of financial year tax planning webinar as well. So
yeah, that's right, mate. That'll sort of coincide with a podcast on it as well. Would be tax planning, so that'll be sort of the first week in June. From that point of view, to sort of space it out a bit, but we will be doing a tax planning webinar podcast as well for everybody.
Yeah, so stay tuned for that. And yeah, we do. I'll give our podcast a plug. We've been a bit slack with episodes lately, but on iTunes and Spotify, it's called 125 Years and Counting. It's just another way for us to sort of get out material and content, and you can listen to it in the car or at home or the like. If you have any ideas or anything you want to hear about, again, feel free to reach out, let us know, and yeah, we'd love to keep educating clients and yeah, letting you hear what's important.
Cool.
Well, we'll just wrap it up there. Thanks, everyone.
All right, thank you, everybody. Hope you have a great afternoon. It looks beautiful outside in Rocky. Just stop recording, mate.